Rule number 1 in investing: don't lose money. Rule number 2: don't forget rule number 1. That's pretty much it. If you buy stuff for way less than it's worth and get a bunch of them, you're basically golden. Warren Buffett, this guy is worth over $100 billion. Yep, you heard that right. So here's the deal. Warren started as a shy kid selling Coke door to door and turned Berkshire Hathaway into a billion-dollar beast. What's special about him? He didn't get rich by inheriting a ton of money or inventing some crazy new tech. Nope, he got there by playing the stock market game like a pro. So how did he do it? What's his secret sauce? Let's jump into how Warren Buffett cracked the stock market code and became a self-made billionaire, starting from his humble beginnings. Warren Buffett was born in Omaha, Nebraska, back in August 1930, just a year after the Great Depression slammed the country. As a kid, he saw how tough life was for folks trying to make ends meet, which made him realize the importance of money pretty early on. Luckily, his dad was a smart guy. Even though he'd just lost his job at a local bank, he used his savings to start his own business selling stocks and bonds, which kept the family afloat. Growing up, Warren was this quiet, bookish kid who loved spending time alone with his nose buried in books from his dad's library. That's where his fascination with investing and business started. Super eager to try out his newfound knowledge, he went to his grandpa, who ran a grocery store, and asked if he could sell drinks around the neighborhood. His grandpa said yes, and 6-year-old Warren kicked off his first business venture, selling Coca-Cola door to door and making 5 cents per six-pack. Soon, he added chewing gum and magazines to his repertoire. By age 11, he'd saved up enough to buy his first stock, 3 shares of City Service, an oil and gas company, at $38.25 each. But then the price dropped to $27. He held on tight despite the nerves and sold them when they bounced back to $40. He made a little profit, but then saw the shares climb to over $200 later. That missed chance stung, but it taught him a valuable lesson. Warren says he's never known what the market would do next, and that's not his game. His game is picking the right economy and good companies to hold for a long time. These early experiences made Warren wise beyond his years. A few years later, his dad got elected as a U.S. congressman, moving the family to Washington, D.C. There, Warren landed his first real job at 14, delivering newspapers for the Washington Post. Not satisfied with his earnings, he took on a second paper route with the Times-Herald, raking in about $179 a month. That's over $3,000 in today's money. Warren used his earnings to buy a pinball machine with a friend, setting it up in a barber shop. They soon expanded to 3 machines, splitting the profits with the shop owners. They sold their mini empire for $1,200, and Warren bought his first property, a 40-acre farm in Nebraska, all at the age of 15. Even back then, it was clear that Warren was destined for greatness. After high school in 1947, he was ready to dive into the stockbroker world. But his dad insisted on college, so Warren went to the University of Pennsylvania, paying his way with the farm's earnings. He got his bachelor's in business administration from the University of Nebraska, but Harvard turned him down for his master's. Lucky for him, he ended up at Columbia Business School, where he met Benjamin Graham, the man who would change his life. Benjamin Graham was an economist and investor Warren admired. The same year they met, Graham published The Intelligent Investor, a book Warren would call a game changer. It taught how to invest smartly by buying undervalued stocks without speculating. Warren became Graham's star pupil. According to Warren, Graham was the most influential person in his life after his dad. After earning his master's in economics, Warren wanted to be near Wall Street, the heart of investment firms and the New York Stock Exchange. But there was a snag. Warren was still a super shy 21-year-old, terrified of talking to people, sometimes even puking from nerves. Determined to overcome this, he enrolled in a public speaking course, one of the best investments he ever made. Investing in yourself is the best thing you can do. The more you learn, the more you earn, Warren often says. Not long after, Graham offered him a job at his investment firm in New York, and Warren jumped at the chance. There, he honed his skills in security analysis, learning to see a company's true value from its balance sheets. But while Graham and Buffett respected each other, their philosophies diverged. Warren wanted to understand how companies worked and believed in factoring in management quality, while Graham focused purely on numbers and balance sheets. Their disagreements didn't last long, though, because Graham retired in 1956, dissolving the partnership. By then, Warren had grown his savings from $9,800 to $175,000. More importantly, he had invaluable experience running a New York investment firm. Ready to strike out on his own, he returned to Omaha and started Buffett Associates Limited in 1956 at the age of 25. Warren set up shop in one of his house's bedrooms instead of renting an office. He got friends and family to invest $105,000 and began applying Graham's methods, but with his twist. He invested in dirt-cheap, struggling companies that were worth more in liquidation, calling this cigar butt investing, picking up discarded cigars and enjoying a few free puffs. This strategy paid off big time. In 6 years, his partnership's net worth ballooned from $15,000 to $7.22 million. As his portfolio grew, so did interest from potential partners. But many were hesitant to trust a guy who looked 18 with all their money. For over 5 years, Warren ran the business solo, writing checks, filing tax returns, and handling stock deliveries. Those who took the leap saw their investments soar, with an average 29.5% compound annual return from 1956 to 1969, quadrupling the stock market's performance. By 1969, Warren was managing $104 million in assets. Despite the booming market and happy investors, Warren was uneasy about rising stock prices. He lives by a motto: be fearful when others are greedy and greedy when others are fearful. Finding good, undervalued investments was getting tough. So, in 1969, he decided to dissolve the partnership and let his investors go, focusing on his own fortune, which had grown to $25 million by age 39. Next up, turning Berkshire Hathaway into a billion-dollar empire. Smart investors like Warren know how to make the most of uncertain times. With inflation at a 40-year high and a recession looming, institutions like Buffett's Berkshire Hathaway might already be gearing up. Some, like Bank of America's chief strategist, suggest investing in real assets like art. Bloomberg says art can be a solid inflation hedge, often outperforming gold and real estate during high inflation. Enter Masterworks, a platform letting folks invest in multi-million-dollar contemporary artworks. Since they started, Masterworks has sold 5 paintings with an average 26.8% net return to investors. Legal disclaimer: past performance isn't a sure thing for future results. But in this bear market and inflation mess, demand for Masterworks is high. Want to skip the wait list? Click the link in the description. Back to Warren and Berkshire Hathaway. In 1965, it was a floundering textile company with stocks at 7 but assets worth at least 11. Warren bought shares at $7.50, aiming to sell them at $11.50. But the owner tried to cheat him, offering $11.37. Furious, Warren bought the whole company and fired the guy. Stuck with a declining business, Warren decided to transform Berkshire Hathaway into a holding company for his investments. His recent bad experience made him rethink his strategy. Enter Charlie Munger, a partner who convinced Warren to switch from buying fair companies at great prices to great companies at fair prices. This shift was another game changer. Warren started looking for companies with a moat, a competitive edge that keeps others at bay. Coca-Cola, for instance, has such strong brand recognition that it's tough for competitors to take a significant market share. Using this new approach, Warren bought big stakes in top companies like American Express and the Washington Post through Berkshire Hathaway. By the late 1970s, Berkshire's stock had soared from 11s to over 290s, and Warren's net worth hit around $240 million. A big part of Warren's growing success was getting into the insurance business. Insurance companies, like banks, have a lot of cash from premiums. Warren realized he could use this money to invest in other businesses, generating more profit. Since 1967, he's been buying insurance companies like National Indemnity and GE Co. This gave him billions to invest in businesses with moats, notably acquiring 7% of Coca-Cola's total stock. Berkshire's portfolio skyrocketed, with its stock hitting around $7,000 by 1990, and Warren's net worth surpassing $1 billion at age 60. Berkshire Hathaway has since invested in many top-tier companies, including large banks like Goldman Sachs and Bank of America. Today, it's one of the most powerful and profitable companies in the world, making Warren Buffett the richest man on earth in 2008. Despite his massive wealth, Warren remains surprisingly frugal, driving a 2014 Cadillac XTS and enjoying McDonald's for breakfast. Warren Buffett, the Oracle of Omaha, has stuck to his principles and integrity, proving he understands the business and investment game better than anyone else. Thanks for watching. Don't forget to subscribe and hit the like button. See you in the next one.